Hi there. Oh, I didn't know I wasn't on mute. Hey, I'm driving my kiddo to school, so I'll just probably listen for now.
Okay, sure thing. Okay. In light of the recent discussions that we've had at Market Analysis, one of the requests that we've had is to explain how longs and shorts work. We have a general understanding we should buy low and sell high. But a lot of people don't know they can sell high and buy low. And that seems like, well, how does that possible? How can you sell something you haven't bought yet? This is the presentation on the birth of futures. Now, for us to really understand futures, the first thing we have to do is understand price action. And so, whenever there is a market, it doesn't matter whether it's a global market or a farmer's market, there is market open and then there's a market close. You're either open or you're closed. It's either an on or off state. In between market open and market close, you have what's called price action. And price action is determined, what do we've talked about this before. What's the value of something? Anything. Whatever someone is willing to pay. So every transaction is a sign of consent on the price. Whatever it is that you're bringing to the market. If you're bringing pierogies and the consent is $7 for the bag of pierogies, then yep, you've got a $7 bag of pierogi on the market. But if someone comes along and is like, ooh, I would like to buy a lot more pierogies than what you have on the table, that makes there some more demand. And so that higher demand may increase the price of the pierogies as time goes on. Now, for us to see this market fluctuation in the price, and this is where we're going to be talking about a little bit of history, but that there's a market open and a close every single day in the stock market. It opens at about 7:30 our time and it closes 7:30 or 3:30 our time. So it just runs for that period of time and then it's over and then it turns back on again the next morning. But that during that time there is a price where things open up. It's like the first order of the day. As the first orders get fulfilled, that's the open price. Then the price may go up as time goes on throughout that market session. Might go down. Might go down a little like this. We've seen some charts where it just seems random. And then at the end of the day, we have the last orders that come down, and that's the close. Now, that's how it plays out throughout the day. So, how do we track this? How do we measure this? And the trick is we have two other parts, two other price points other than the open price and the close price. We have a high price, and we also have a low price. So this, now we have four parameters to the price action. We have the open price, we've got the high price, we've got the low price, and the close price right there. Now, this is a lot of data, there's a lot of squiggly lines, and so the Japanese actually came up with a brilliant way to represent this price action throughout a market throughout a market's being open. And this was invented when in Japan, believe it or not, there was an impetus that made it where the local currency in Japan because it was so rice centered, their agricultural society was so rice centered, rice was the reserve currency. And so, in order to measure the price of rice, and that was fluctuating, it was fluctuating throughout those times. And so, in order to keep track of this, they had to come up with a way to measure this price action. And so, what they did was they created what's called the bar. And it's just a single line. We see this all the time when we look at our charts. We see this bar, and it looks something, well, actually, you know what? Let's bring it over here. We're going to move it over to here. So there's the open, close, and all that stuff. We're going to start the bar here, and we have the high and the low, and that is the extent of the bar. It goes from the highest price down to the lowest price, right there. And then they make a little mark right here for the open price, and then they make another mark down here for the close price. And whatever happens in between is really not that important. The important prices are the open, the high, the low, and the close. And these are marked. These are typically identified with O, H, L, and C, just like so. Let me move it over here. So this is what makes up a bar chart. Typically speaking, the next day, close becomes the open. Unless, of course, there's a really drastic change in the volume, or someone else has got a bid in for first thing in the morning, and it ends up being a better price for the Bears or a better price for the Bulls, who is ever in charge. But typically speaking, we go from any market close to the next bar as the open. And then the price action might do anything like this, right? It might go up and down a little bit, and it just goes up and down, but that it measures all in one stick, and then it's like, okay, there's the close. That's why we see the chart when we look at the charts. That's why we see so many. Oh, that's not sharing. Hang on. And oh, I see. That's why it's not sharing. It got moved over to this screen. When we look at the charts, we see them represented in these bars. So you can see where that open high is very, like right here. The open is here. It goes up a little bit, and then it comes down, forms a low, and then that's where the close is. And then there's the open, goes down a little bit, and it ends up close. So we determine the direction of the market based on whether or not the open and the close is either higher or lower. So if here we see that the open gets beat out, that the bulls, we call them the bulls, those are the people who are charging, and they think the price is going up. They're the optimistic ones. The bulls, they won because they brought the price up, and they closed this particular day up here. And so we call that a bullish bar. And then the next one, it opens, look at that right next to it. And then that bar goes up and it closes higher. So that's another bullish bar. And then the sequence of them creates a bullish impulse where there's many bars going up. And then you've got the bars, these ones are going down. You can see that the closes are progressively lower. And that's how we see highs and lows get formed throughout time. And all you need to do, if you ever want to zoom out from a bar to see less of this detail, all you got to do is go from a daily chart to where now the prices are measured in the week. So instead of the highs and the lows being shown every single day, or rather those 4 price points, the high, low, open, and close being shown on every day. Now you can see them when I click on week. Now this is how it would be represented if it was just the open of the week, the high of the week, the low of the week, and the close of the week. Audrey Lynn, you got a question?
Are those numbers averages of the day?
No, those are direct moments.
Oh,
So as soon as 7:30 opens up, what's the first order that comes in? That's the price. That's the open price. Oh, you're muted again.
from Monday to Friday, do they average those prices over the course of the week to get the weekly chart?
You could. No. Oh, I see. Nope. On the weekly bar, it's Monday morning to Friday night.
Okay.
So Friday morning is the open, and then you might go up on Tuesday, down on Wednesday, and squiggle all over the place all week long. You're going to form your high and your low, just like you would any other market session. It's just a difference in time frame. Yeah, good question. Really good question. So when you are, yeah, and I can briefly talk about these terminology because we want to talk. Or the reason why we wanted to give that as a background is because we're going into what are called the futures, and the futures are a method by which people can trade. This is they can speculate on what the price is going to be later. And if the price is going up, then you're going to show your conviction by buying. If you think the price is going to go down, you show your conviction by selling. But how is it, and this is where we get into the whole money system. How is it that you can sell something high if you haven't purchased it yet, if you haven't bought it yet? And how is it that when you close the trade, you're buying it? How is it that you can buy something after you sell it? Well, I mean, I guess you could if you buy it back from the one you sold it to, but it seems like cognitive dissonance. Buy low, sell high, that makes sense. But how can you sell high and buy low if you don't have it bought first? So the first thing that we need to identify is that we're dealing with accounts, just like everything else out there in the financial world. We're dealing with accounts. So when you go to a broker and you say, I want to do some trading, the first thing they tell you is, okay, well, deposit into this trading account. And the trading account is usually denominated in USD, depending on where that exchange is. If you're in Canada, then you'll see it in Canadian dollars. But it doesn't really matter. It's going to be the base currency of that jurisdiction. We're going to use USD just because of the volume of trades that occur in cryptos with the USD. So USD gets deposited into this trading account. And then you tell your broker, you say, okay, there are some assets out there that I would like to trade. But I want to be able to switch back and forth, open and close these trades so that I can profit no matter where the price goes, where the price does. And so in that trading account now, let's say, for instance, you have $1,000. That's great. You put it in there, and that is this is a segregated account. This is very important. A lot of people think, oh, I lost so much money, and because they see, there's $200. Oh, I lost $800 out of my trading account. No. What you did was that you bought $800 worth of stuff, and that is in a separate account now, because we're not dealing with the trading account anymore. Now we're actually dealing with a trade. And so you get $800 worth of stuff because you think it's going to go up and you're going to be able to sell it at $1,200. That's the goal. So this is going long. This is a bullish sentiment. You think it's going to go up, and so you buy, And those $800, they go into the trade itself. Or another way that they measure this is called a margin account. The other one is a trading account. This is called the margin account. I should put that up here. Now, how is this margin account denominated? Because if you're buying something, you're not holding the dollars anymore, right? It's $800 worth. But what did you actually buy? Well, that is going to be units of the instrument, whatever it is. So let's say, for instance, we're going to use the example of foreign currencies just because it's a little bit simpler than trying to figure out stocks and all that stuff. So let's say it's $800 worth of US dollars worth of Canadian dollars. Well, that means that you're actually getting about $11.50, and it's almost $1,200 now. You're getting about $11.50 Canadian dollars. So that's what you're actually buying. That's the product that you're actually buying. You're not buying $800 of stuff. Oh yeah, you're buying $800 to get Canadian. Maybe this isn't the best example because it's confusing with the dollar thing. You know what? Let's go with a stock. Because then it's a separate entity, a different form of equity. Let's say it's, you know what? Let's go with SpaceX. The meme coin. So you're getting $800 worth of SpaceX. Your hope is that it will go up 50% in price so that you can sell that $800 worth into 12. That's going along. And that makes sense enough. But now, how do we reverse this? That's the question. How do we go from 1200? Let's say it's at 1200 and you're like, no. I'm going into the market now, but I expect that this is going to go down in price later on in the future. In the future, I think it's going to go down in price. So I don't want to take the dollars and purchase the stock. What I want to do is that I want to have the stock purchased at a future price. And so I'm taking out a loan on $1,200 worth of the stock. So I'm going to get SpaceX, and it's going to be, let's say, just for all intents and purposes, SpaceX is $100. So I'm getting 120 SpaceX in the future. But in order to do this, I have to take out a loan because it's for the future. So you are actually selling 120 SpaceX. But the price goes down, and by the time it gets here, that money that you set aside can purchase 50% more. So now it's 180 SpaceX. And all you got to do is find a buyer at this price. So, and then you get the difference between that. So your loan here is for $1,200. As the price goes down, it gets purchased for $800, and you get the difference between the two of those prices. Now I'm going to stop because as I'm explaining this, it makes sense in my head, but I want to make sure that other people are getting this. Is it not making sense, Audrey Lynn? Okay, all right. Then now you got to start asking questions. Because to me, I'm saying this and I'm just like, I can tell it doesn't make sense.
So walk me through how I get the difference between the 1,200 and 800.
Yeah, if the market agrees with you. You don't get it if the market doesn't agree with you. If you think the market's going to go down and you get 120 SpaceX
Right.
and the price goes up, now the market's working against you and you're never going to find anybody to deal with you to buy that asset. No one is going to close on that for you because no one's going to take a loss for you. So I'm gonna find another way to do this. Remember, there's the trading account. The trading account has the $1,000 in it. And then what you're doing is that you are telling your broker, you're telling your broker, at this point, I need to take out a loan for 120 SpaceX. And so that's today's price. So that's what it's worth. That's what you have to pay. So you're selling it. You're selling the SpaceX. No, that's not a good way. How do I? Yeah. Okay, let's go back to the margin account. I see where I'm going, where I'm missing it. So let's go back to the margin account. A margin account is denominated differently. It's a margin between the two forms of equity that you're looking to trade with. Okay, so if you have USD over here, then you're going to see a slash, and then you're going to see SpaceX. Those are the two things that can go into the margin account, and you are putting one of two things into that account. You're either going to put SpaceX in there or you're going to put USD in there. If you put in SpaceX, it's because you bought it. If you're putting in USD, it's because you bought it. If you're putting in USD, it's because you want to purchase SpaceX later when it's at a better price. So, so if you are going long, you're buying SpaceX. If you're going to go short, you're taking out a loan for US dollars, saying, I'm putting in $1,200 right now, and then I'm going to close this trade. It's a better way to put it. Close this trade when I can get 180 SpaceX with those dollars. And what you're doing, you are actually not, you're technically, you are swapping the units of dollars, right? So you have US dollars here, and you are swapping it. So now in your margin account, you have SpaceX, but you got 180 SpaceX for 120 of the past price. You got it on sale. Because you got it on sale, you saved money between those two price points, didn't you? Big time. And so the difference between those two prices is your profit when you buy it. You close the trade, and now this asset, 128, now it's like, okay, I got 120, I got 180 SpaceX. That gets turned into liquidity when you close the trade, and that difference, the differential, that gets sent as dollars back to your trading account, and you see it as profit. Okay, ask questions. Another way to look at this is these are futures, right? That's what this is. This is called futures, because what you're doing is you're trading on the future price of an asset, and you're taking out a loan to sell it in advance, basically. You don't have to own it. You can take out a loan. What if we tried it with another type of asset? Let's try it with a house. I'm going to try this out. I've never actually drawn a house on screen before, so this is going to be interesting. Oh no, let's go like this. And I'll put a chimney on it and a little bit of smoke and a nice walkway. Okay, so this house in 2020, and then there's 2026. This house in 2020 was $400,000. In 2026, the house is going to be, same house, it's going to be worth only $300,000.
But there's equity. There's an equity accumulation in those years.
Yep.
And the equity is what you've paid off on your loan. Is that correct?
Yes, that's correct.
Okay.
But the house itself, market value, is this.
Right.
How much you pay off doesn't really matter. You can make money off of the spread, because as you pay it off, then you get more against that, right? But let's say, for instance, well, and this is only a 6-year payment, right? So if you've only been making payments for 6 years, most of it is interest. So you haven't really paid that principal down at all. So as time goes on, this works against you. How do you make it work for you? You take out the loan for $400,000 and you say, I'm going to buy real estate with it when the price is lower. Normally, I would be able to get one house, but 6 years later, I'll be able to get 1.25 houses. Now I have an asset that's actually, this is equity now, right? This is a liability. Big time liability. That's why in The Big Short, the investors were pissed off at him, because he was leveraging this money and there was no asset backing it. In fact, the asset was just keeping on going against that market, that price, right? So he took out a loan for $400,000 so that he could buy more of the stock later to close that trade. But who buys it here? That's a good question. Who buys, who does these trades? Who is actually facilitating these transactions? It's a broker, not you. You're buying the property in 2020. Or sorry, you are buying the loan in 2020 for the settlement of a purchase that occurs in 2026. I'm still not accomplishing this. To me, it makes sense, but I gotta get good at explaining this. Zoa's here. Hang on. The worst of this is that I'd have to explain all of this again, and we're 29 minutes in. How can I summarize this?
Oh, that's not your job. If I missed it, I missed it.
Audrey Lynn, ask more questions.
I'm lost at how a gain is realized at a lower amount of dollars.
Right, because you're holding on to the dollars. During this time, as the price is going down, you are actually holding an asset. The equity is in the form of the dollar. So the dollars don't go down in value at all.
How do I go from 120 SpaceX to 180 SpaceX when the 120 cost me $1,200, but the 180 is now worth $800?
Yeah, it's like that's the same price as $1,200. Like, so how does that make money?
Yeah.
Yeah, it's because the asset that you're actually taking on inside the margin account is the US dollar, not the SpaceX. You're saying I'm speculating. You're speculating, and so the market is happy to take your money on a speculation because it's like going to the casino, right? So the brokers, they love this. They love this. They love the fact that they can sell you a contract on a future price. So you're buying the contract with dollars, and as the dollars maintain its value and the stock goes down, or the rice goes down in price, when it comes time, you can say, okay, I'm ready to close this trade. And what that means is the broker is going to buy the volume of your $1,200 in stock.
Okay.
Yep.
I think I'm getting it. So as the price of the stock goes down, then you take your US dollars and purchase them, thereby
Correct.
getting more stock at a lower price.
Yes,
I'm getting it.
and the difference, that's the differential.
Right.
That difference between those two transactions has got lots of profit.
Got it.
It would be like you just increased your equity by 25%. Right? You increased your equity here by 50% simply because of the volume that you were able to purchase. Up here, if you would have bought it, you would have been shit out of luck. It would have worked against you because the SpaceX went down in value. But the US dollar went up in value compared to the SpaceX. That differential, when you close, that differential gets deposited into your trading account, and that's when you can say, there, I made money. And what was going on with this, once this was something that could be charted, once they could make a visual representation of that price action, then it opened up a lot of possibilities for people who had pattern recognition as a superpower. Because what they were doing was that they were taking different things. They would take silver and rice, and they would literally put them on scales. Yeah. And they'd be like, okay, so right now, 1 ounce of silver is worth, whatever, 1 ounce. Let's say it's not, but let's go just something more realistic. Let's go 1 ounce of silver gets you 100 pounds of rice. If you think that the rice is going to go down in value, then you're going to want this equity here.
Mm-hmm.
If you think that the rice is going to go up in value, then you're going to get this equity here.
Mm-hmm.
And you're just trading two forms of equity in the same account.
Mm-hmm.
When you close that trade, the differences are settled, brokers take their fees, and you get the rest. Does that help?
Mm-hmm.
So to short something, you're actually buying the other form of equity in that moment. That loan that you get, and this is where things get dicey, because some brokers, they'll say, what do you have in your trading account? Oh, you got 1,000? Oh, that's awesome. We will loan you. This is the stock market, okay? Stock market will loan you $25,000. Yet, without a credit check. They will say, oh, you got $1,000? Why don't you trade as if you had 25,000? And the future trader will say, I'll take that bet. I think it's going down that much. I'm willing to leverage my $1,000 25 times. What did Trump say a couple years ago? The stock market was like a casino. Yeah. So 25 to 1. They will let you borrow the dollars to short the stock.
So the stock market is like a casino. That means it's rigged
Yep.
for the house.
And it's rigged by who? There's the question.
Those that run the world.
The exchanges. They are 100%. And they are commonly known as exchanges. So, that's the terminology. And that's the origin of the bar chart. Oh, that's something to discuss. The bar chart ended up becoming more commonly, people they don't look at bars. More commonly, people are going to look at a different form of this, and they call them candlesticks. And they're just a pain to draw, but I'll show you what it looks like so that you can see the correlation. And they call these wicks because they're candles, right? So now you still have your 4 price points. You got your open, your close, your high, and your low. Obviously, this is the high and this is the low. But how do you know which is the open or the close? Like, at least with this one here, the open is on the left and the close is on the right. So how do you tell with this? I'll show you. You could have 2 bars and they look identical in this way, but they have one difference. One's shaded a different color. So, and typically speaking, depending on your configuration, whatever your preferences are, you would say that this one here is bullish, so that this is the open and this is the close. And then if it's colored, this is the open and this is the close. I don't like it like this. Why? Because when you actually look, let's bring up the charts. When you actually look at the price on here, you're looking at one color for everything, right? It's just all white. It's all just white bars. And I use the colors to signify different pivot points. Let's go to a clean chart. Let's just go to USD yen. There we go. Oh, no, that one's got line. Oh, that's fine. Okay, so this is the bar chart. And how it looks when you go into actual candles, you can change it in TradingView. I'm going to click it to candles. Now it's green and red, or well, kind of like a orangey red. So now it's easy to tell. Green is bullish, red is bearish. But here's why this is the most common way that people look at charts. I don't like to look at charts this way, and the reason why is because when you look into the emotionality that is associated with these colors, it is fear and greed. And you don't want your emotions to be amplified when you're looking at a chart to determine what you should do. You should not be using emotions. But they make sure that people have more emotionality by simply coloring the bars a specific way and saying this is how you read the charts, when in fact, it was the Japanese that invented this for mathematical purposes, not for emotional purposes. So, there. That concludes our lesson for today. Any questions? Well,
Is this the thing that we, in a previous session, we said we were going to come back and look at?
yes.
Okay.
Yeah. I think it was on Friday, or maybe it was on Thursday, where we talked about talking about the long versus short and how that works. How can you sell something you haven't bought? That's how.
Yeah, I think it was even earlier because we talked about doing it Thursday and I said I couldn't be there. And so then we were going to do it Friday, and then Friday I totally forgot. So anyway,
yeah.
here it is. And I still don't know quite where I find the recordings. You send them. Sorry, I just don't remember. I do want to watch the recording, but.
Oh yeah, no worries. Well, and I don't mind answering more questions. But don't feel like just because you showed up late, you can't ask questions. That's fine.
Yeah, but I don't want to. I want to have the experience. I want to have the. I want
Okay.
to hear your whole thing, and then if I have questions, as opposed to ask questions that make you go through the whole thing again. It's like, no,
Okay.
I want to hear what you did.
Sure. Yep, I didn't have anything else. I'm grateful that I got a chance to talk about that, and it's good for me to present because it's, well, I've known about it and I can think in that way for a long time, but to communicate to other people, it's very helpful to do this as a review for me. I'll just quickly scan through. These are the tech markets here. Things are pretty much. Oracle still trying to recover from its big drop here over this last 8 months, 9 months. Palantir last week got a big jump. Big jump. US dollar, Japanese yen, you can see that they've been pressing that price down by purchasing more of the currency to try to get the demand up a little bit. And this is where things can get confusing, because it's like when they bought the US, or when they bought it and it went down, what does that mean? What did they do? They sold US dollars to purchase yen. That's what made this price drop down to avoid the yen from to basically put off the inflation by buying up a bunch of it, right? If there's too much of a surplus, then inflation runs away, right? So in order to stop inflation, we can take these US bonds and we can turn them into Japanese dollars. Just, it's borrowing Peter to pay Paul. Anything to keep the sheeple asleep. Because if these prices were actually unregulated, it would be way more volatile, and people would just throw their arms up and say, screw this currency, right? So they got to do these kinds of things to just suppress the uprising. And it's like that fine balance. How much do we twist their nipples and versus how much do we let off so that they stop screaming? And which citizens like it? Japanese markets breaking out of that short-term downward trend there. US 30 hitting another all-time high there on August 5th. We have to adjust our gold prices here. That's definitely going to be different now. Get the calculator out, and 53,893 divided by the gold, 4360. That brings it, oh, I actually brought it down. Oh yeah, because gold had a little bit of a jump too. 12.36 ounces, and in silver, $53,893 divided by silver price is $65.18. 826.
So that's how many ounces of silver or of gold it would take to buy this stock
right.
at its current price in the unit that, like, is it sold in a certain unit or is that just measured in a certain unit?
Yeah, it's measured. So because you can purchase increments of you can purchase this in increments of 1 cent with a, depending on your broker. So if you were to purchase one entire index, that's $53,894 today.
Which would mean one stock from each of the 30 companies that are in it?
No, it's an index of the top 30. So you take all the top 30 companies and you put their stocks together. That's what
I tried to say anyway.
Okay.
It's like you're buying one pie with a piece from each of the companies.
Yeah, that's right.
Maybe one pizza.
Yep. Crude oil. Here we have another little bit of an update. Looks like that trend line that we've had running for a while now, that trend line is definitely getting some support right now. We'll see whether or not the price continues to rise, but I am pretty certain, based off of the trade volume that we've seen, that there was another, they shorted oil after the price went up. They shorted the oil, meaning they put in $5.51 million worth, because we take a look at how they've been progressing. and how much they've made during that time. So they took the $5.51 million worth, and then they would have come back and got it at another 17-18% off. So that means that the equity value has gone up 17-18%. So we take 5.51 and we add 17%, and now they're up to 6.44. These are approximate. Get that these are approximate, but that they will all, that have that knowledge, insider trading, they're always going to be purchasing around these pivot points and buying and selling around those pivot points.
When you look at a chart, can you tell that there's been more volume or less volume just visually? Is there something that indicates that?
Yeah, totally. That's why I like to put up these rainbow colored lines, because those are areas where there's higher volume, and they are indicated by the pivot points. So wherever the price action reverses direction. Sometimes we see the bears and that's another thing. Throughout these charts, whenever we see price action here as the price was going down, this is what we call the bears winning. So the bears have their sentiment and the bulls have their sentiment. As the price goes down, it's because the bears are winning. If the price is going up, it's because the bulls are winning. And it's just, where's the equity going? So as the price is going up, we see that there's a pivot point there. And it's at this green line that I have marked. But what we do is that we go back in time and we can see that that green line had a pivot point here as well. There. Also here. Also this little one right here. And it's just uncanny how much the price action is reversing within that area, either from above, going down and bouncing off of it. We call that line of support because it's supporting the price action from below, or we might see it showing resistance like right here. So that's resistance, where the line, that price point, is providing resistance for the price, pushing it back down again. So wherever we see the price do those reversals, it's very likely that we will see the price reverse in that area again. And it's because it's a high volume area. People want to make their money, and they want to make their money in the areas where there's more likely to be a trade. And so higher volume trading is where the bulls and the bears are competing more. Does that make sense? They are closer in their competition.
So it's more a general, it's not like you can look at it and go, oh, there was a lot of action on Monday, or...
There are volume profiles as well. So this is a volume profile where the color will, it'll press forward, or rather give more intensity to price levels that have higher volume. You can get that data as well. And it's especially helpful in longer term trading. The longer the term of your trade, the more important it is to look at the volume. If it's a shorter term trade, it's really more important. I find it more important to look at levels, right? This is a high volume area of trade. And you can see that's indicated by that line. However, look at how it coincides with this whole zone where there's tons of pivot points. Those pivot points, to me, provide a clearer indication of the volume than a volume indicator, unless I'm looking for more granular data. And that changes as well, right? Because this chart, as it is right now, this volume indicator is giving us that heat zone, we call a heat map, where most of the trades occur. But that's based off of the last 500. Is that right? Yeah, 500 bars. Or is it 200? I think it's 200. Let me just double check. Yeah, okay, so it's 200. Yeah. Look back 500. Is that 500 units right there? Let's just see here. Oh yeah, okay. So that's 500 bars is what that is. So I can say like, okay, well that's the volume heat map of the last 500 bars. What if I want the heat map of the last 1,000 bars? Well, then it pushes that heat map back a little ways so that we can see 1,000 bars worth of volume. I don't mind getting better data on the volume, but still for the style of trading that I do, which is I'm what's called a swing trader, but I also combine swing trading with dollar cost averaging. And so in that realm, my objective is to enter and exit the markets when the volume is higher. And I have a better chance of seeing where the bulls and the bears have a common ground, because I'll be able to execute my trades with more accuracy. Simply because it's a high pivot zone, right? Lots of pivots occur.
I came in late, but I'm wondering, the bar is a trade?
Oh, yeah. So the bar itself, we talked about that. I'll bring it up here on this. Yep, here we go. The bar, what that does is that it shows us the price action between the open and the close. Oops.
Thank you.
So there's the market open and the market close. The market open being right here. And this is the market close right there. And we can see that there is a price that's actually lower than the close, but it didn't stay there. It just bounced off there and then kind of went up and down. And then at the end of the day, the market closed here. And so when we see a bar, what we're seeing are those four crucial price points. There's the open, which is at that price over here. There's the open. There's the high price. Here's the low price, and then there's the close. So that is how the bar itself gets formed during that time.
Oh,
This could be this could be 1 day. This could be 5 minutes. This could be
what a
anything.
simple Geiger counter. I love that.
Yeah. That's
Neat.
right. It was invented by the Japanese.
No wonder. That makes sense. Efficiency of information.
Yeah, and then it was, of course, the mainstream that had to go to the candlesticks because they wanted to get the emotionality back into the game. Whereas the Japanese were like, no. We don't want to see an emotional representation of the price action. We just want to see the 4 price points: open, high, low, and close.
So when
Sometimes-
you can thing for 500 bars, you also get to choose whether it's an hour chart or a week chart.
That's right.
Okay.
And it's also important when you are looking at trades and you're trying to determine the direction that you're going to be headed. It's very important that you remember this simple phrase. Higher time frames rule over the lower time frames. So you could sit there on the 4-hour chart and be like, oh, we're headed down. But if you zoom out, the daily chart will say, no, you're headed up. and that you're just experiencing a little bit of a pullback. And you always want to make sure that you're trading with the trend. Don't try to catch those movements thinking that you're going to nail them all. You want to trade with the trend.
Just to clarify that, like silver right now is going up.
Yes, but not on a higher time frame.
Not in a higher time frame. Okay, so that's the.
Well, you got to go to a higher time. You got to go even to a higher time frame to find it going up. Let's go back to that. Here's the silver chart. Right now, we actually have a downward trend.
Okay, so it's down today. Okay.
Silver, no, it's up. It's up today,
I see.
but today is just this little bit right here.
Yeah. So the
So
trend
yes,
is down.
the trend right now is down, but I believe that we are starting to see an upward trend. We have to get past the resistance that will be present from this downward trend line. Once we get past that, I would expect it even to come back down and test that trend line one more time as support before headed up to the next high.
Somehow I'm understanding this a little bit better. It's making sense. Probably
Yeah.
the second time I've heard it, but yeah, thanks, Paul, for going over it again.
Oh, most welcome. One thing to be also, can I do this? Oh yeah, I can do this now. Okay, so this area right now, where we are, right here, look at how we're even experiencing some resistance. If I zoom in, actually, we'll zoom in with the hourly chart. So this is now every bar is 1 hour of time, 1 hour of price action. We've been butting up against this now since Friday at 6 a.m. So we hit that high and then we hit it again. So right now we're experiencing some resistance. Why would we be experiencing resistance? Well, in the past, we can see that this area provided resistance and support because it's a high pivot point area where the price action likes to reverse. This we know is going to be a favorite area for that battle between the bulls and the bears to tip. So you're right, silver is up. If we look at this chart, like just go to this chart here. This is the hourly chart, and we can see silver's on the rise. But always remember and it's not wrong. It's on the rise on the hourly chart. Always take a look at the bigger picture, and this bigger picture here shows that silver's on the low and it's going down, right? We're not actually trending up at all. We have a ways to go before we trend upwards. We have to get up past this high. We have to get up above $89. We're sitting at 65 right now. And if it gets above that, that's when we can confirm we're actually headed up because we have a new higher high. But then again, we got to zoom out even further from another perspective because there's the weekly chart as well, which shows silver's on the up big time. So it's always it's always what perspective, right? If this here is what I like to trade, simply because the reaction time is a lot nicer, right? If you have a low reaction time, you're going to miss trades and then you miss opportunities and all that stuff. So
I'm not sure what you mean when you say this is what I like to trade. What is this?
Longer time frames.
Oh,
Yeah. Because your accuracy goes way up. You don't make as much money in the short term, but you have a higher accuracy, which means in the long term you make more money. Well, yeah, there's an art to that as well. Here I am just talking out my ass. There are ways you can make money in short term too, but you got to know what trend are you in. If if, you know, let's say for instance, silver right now, we can see that weekly trend is going up, and it's going to continue to do this for a while. That means I wouldn't short it, because even if the trend says here that it's going down on the daily chart, I know that the higher time frame rules the lower time frame. So knowing that the weekly chart is showing the rise, I tend to agree that, you know, silver's up right now on the daily chart, and that's in line with the weekly chart. It's not in line with the daily chart. So this is, and the fact that on the daily chart, on the daily chart, it's showing a downward trend. That is counter to the weekly trend. But now that we go into the 2-hour chart and we can see that rise, like we're at a high here since June 22nd. Last time we were at this high. So seeing this chart and the rise, I would say, yeah, now's a good time to buy. Why? Because the weekly chart shows that we are on trend. We are trading with the trend. So another good saying, rule of thumb, the trend is your friend. If the trend is bearish, like let's go look at a bearish symbol right now. Oh, yeah. Here we go. Here's a bearish trend. It's on SpaceX. I would not be looking to purchase this based off of this chart. I would need other data. So buying it right now, I would be going against the trend, and the trend is your friend. So whatever it's what you see the trend being, whatever that is, here's the daily chart on gold. You know, people say, oh, gold is down so much. It's like, no, it just came back and hit market structure is what it did. Look at that. Beautifully hit market structure. Does anybody remember when gold was $4,300 back in October of 2025, almost a year ago? Does anybody remember how excited everybody was? Oh, gold, it's going up. Woohoo! Yeah! And then gold went beyond that and it went up to 5,500, 5,600, 5,598 to be exact. And then it came back. Look at how it came back. It came back to rest. Where's that bar? There we go. After that all-time high, the price came back and it hit this pivot point. Well, what pivot point is that? It's the price that everybody was freaking out back in October 2025 was the all-time high. So the price just came back and settled itself on a previous pivot point. Then it went up again, and then it came back down. And then the next pivot point went even lower. And then it went down again, June 2026. And it's been bouncing off of those lows ever since. But those lows at 3,900, well, that's just market structure from October 2025. Zoom out, and gold is it's doing quite well. It's just following this trend line from September 2023. I like showing it in these different perspectives because, it's kind of like what happened with the US 30. Right? It's like the stock market was at the highs in 2015, right? And then COVID hit and the stock market came back to 2015 levels, back when everybody was rich. And here's where they call crash. Right? It's funny.
I love it that you do this too, Paul. I really appreciated it. Really solidifies, it consolidates in my brain. So
I'm glad. If the markets were to crash now, like the 28 to 30% that would be expected, we can zoom out and we can see just where would 20 to 30% take us. Oops. Well, here's 30% right here. Oh, look at market structure from April 2025. Oh, look at that. Oh, I didn't see that until just now. So here's April 2025. Price was a low of 36,500. Today, it's 53, right? This is like magic, guys. So the market says that it's up in the last 489 days. The market is up 47%. See that? 47% rise in the market, and everybody's excited because the stock market's at all-time highs. Wait. What was it at market structure in April 2025? It was $36,500, but it was also 12.36 ounces. What was it? I just measured it today. Look, 12.36. Very same today. It's worth the same in gold today as it was in April 2025. Isn't that crazy?
It is.
So they're lying. They're telling you that it's, the stock market's gone up 47%. And in fact, it has been stagnant the whole time.
Wow.
Zero growth. Against what they call God's currency.
that should be the name of this post. Paul.
What name it? What God's currency versus man's?
Well, just zero. The stock market has had zero growth.
Oh, yes. Yeah. Yeah, the stock, the markets are lying to you by 47%.
Exactly. That would be a very good title.
Okay. Thank you for that suggestion. I'll make sure I get that up there.
Then you need to make a face on it.
Oh, right, like the YouTube art where it's like
Yeah.
the still.
They all go to, what is that called? The Scream?
Yeah. Okay. There you have it, folks. Market analysis for Monday.
So Maureen, prior to us coming on, Paul went very much into the understanding shorting. So this is one for the, what do they call it? One for the archives or something? I mean, they all are, but
This one here, yeah, this one was more educational on the technical.
Paul, can you imagine my surprise as I went on my YouTube channel and there was a picture of you and me?
Ah!
You know,
What?
there's nothing more surprising than seeing yourself on film.
Yeah.
But with it on YouTube, then I could watch it easily. This would be a good one to watch again.
You haven't
I-
been doing them on YouTube recently, right?
Not many of them, no.
I've started not asking, but maybe I should before when I come on.
Yeah, I think that settles it for that. Maureen, are you and I on here in the next 10 minutes? Oh, you're muted.
Could we make it 20? Because I've just got breakfast and I'd love to have it outside if it's okay with you.
Oh, yeah, of course.
At work?
Absolutely.
Okay. And anybody's welcome to join me.